Welcome back to the NEOS Monthly Income Podcast. I'm Tom Lydon. Each month, we're joined by our founders, Garrett Perella and Troy Cates, where we talk about and focus on the importance of tax-efficient monthly income. Troy, Garrett, great seeing you guys.
Great seeing you.
Great to see you, Tom.
Also joining us, a special guest, Paul Riccadella, who's the head of index investing at MSCI. Paul, thanks for being with us too.
Thanks for having me. Great to be here, Tom.
So, Paul, we're going to talk about international, but first, Garrett, Troy, you guys have some exciting news to share about your first international ETF. Garrett, tell us a little bit about it. And what was the decision-making behind that?
Yeah, thanks, Tom. We're excited to continue to offer, solutions-based products to all of our investors and partners out there. And this is just a follow-on that we've had a lot of discussion and hearing from a lot of investors around the interest within international equities. Obviously, a lot's going on domestically here in the US and what we're seeing from the administration and from the Fed. And so there's been this deep desire for exposure to international equities. And, one group that we obviously thought about first and are excited to partner with is MSCI, which is why Paul's here. They arguably have the largest opportunity within an international index that's tracked, and I won't steal his thunder to be able to talk about it. But the concept was, how do we take our NEOS tax efficient, high income based strategy and overlay that across international equities? And so we're giving investors the ability to gain that exposure, but do that right in a highly tax efficient income based product.
And Troy, you have a unique relationship with your shareholders. There's a lot of feedback and it goes both ways. Many shareholders give you ideas, and I understand there was demand for an international offering.
Absolutely. There was definitely a demand that we were seeing from advisors. I mean, just hearing in the space that, we've really grown NEOS and brought out these really nice solutions across equities, fixed income, alternative. And everybody was asking, when are we going to go international and how is that going to look? And we did it, as Garrett had said, partnered with MSCI. So we're really excited about the partnership and the offering of what we're doing here, and also to be able to trade the index options in the US for the international exposure is really exciting for us.
Paul, thanks again. And MSCI, those of us in the industry know MSCI really well, but if you're not familiar with MSCI, tell us a little bit about what MSCI is all about.
Excellent. Yeah. So look, simply put, Tom, MSCI is the index provider behind many of the ETFs and investment products that your audience uses every day. There is literally $1 trillion in ETF AUM benchmarked to us in North America right now. There's about another $140 billion in direct index SMAs. And all told, our ecosystem is about $17 trillion in AUM globally amongst wealth, direct to retail, institutional investors. About a third of that 17 trillion is directly index tracking. So we're a public company. We've been around 55 years, $3 billion in revenue. Indexing is the majority of what we do, but we also have a footprint in analytics, attribution, sustainability, and private assets investing.
Great. And Paul, the ETF we're talking about is the MSCI EAFE High Income ETF, and the ticker is NIHI. EAFE is a part of that title. Can you tell us, what does that stand for?
Yeah, so the literal meaning of the acronym is Europe, Australasia, and Far East. In terms of practical application, EAFE represents developed markets outside of North America. So no US, no Canada. Top holdings include Japan at 22%, the UK at 15%. It's been around for decades, and it is the most well-established index for international developed equities in the world.
And that's part of the reason going international, going big, and going with the best that Troy and Garrett and the team selected, but also not a bad year to include international. Talk a little bit about developed outside the US. It's done pretty well.
Yeah, so it's been a phenomenal year. As of the end of the third quarter, close of business on September 30th, MSCI EAFE has returned 25.1% year to date. And as a frame of reference for the audience here, MSCI USA, effectively our equivalent of the S&P 500 over that same time frame, has returned 14.7% year to date. So we're talking about a 10% performance premium in the first 9 months of 2025 for developed markets ex-North America.
And in fairness, though, it's been really tough to beat U.S. large cap S&P or your index for large cap, but also you've got a valuation differential, which is pretty extreme as well. put that into reference for the listeners here.
Yeah, so look, you're absolutely right, Tom. The reality of this situation is US equities and especially large cap growth stocks have had a tremendous run over the last decade, but really since the 2020 COVID pandemic. And that outperformance for the US has pushed valuations of our market way above historic averages. And just to kind of put a fine point on this, we're talking as of the end of the third quarter, MSCI USA is trading at 28 times earnings. Now, if you look at all the historic data that we have back to 1970, it averages about 18 times earnings. So 50% above its historic average. If you compare that to EAFE, it's trading at about 17 times earnings as of September 30th versus an average of 18.7 times since 1970. And the reason that we compare current valuations against their average is because there are very rational reasons as to why some market or another commands a premium. But the point here is US is very much above its historic average. EAFE is selling at a discount right now, and so it's worthy of consideration.
Right. So Garrett, Troy, when you think about the valuations, and maybe there's something that you could add here, hey, it's the right time. Valuations are still cheap compared to the US, but also your advisors are asking for diversification with the same type of driven motivation towards that monthly income. What else would you add as far as why adding international makes all the sense in the world in the overall NEOS suite? Troy, I'll start with you.
Listen, I think when we talk to advisors, they come to us initially for income. And then they're starting to look at our offering. And Garrett and I talk about it a lot. We look at ourselves as a solutions provider. Whether you're looking for US long equities in the S&P 500 or NASDAQ 100, or hedged equity, or some alternatives in Bitcoin and gold, international for us was the next step that made the most sense. Outside of hearing the demand for it, we wanted to offer our clients and investors a place where they could still get exposure to our active rules-based strategies using the option strategy on top of an underlying reference asset, but we wanted to give them that international exposure for all the reasons Paul just walked through. Outside of the performance, it's really just a good diversifier when you're thinking about your overall asset allocation.
And Garrett, it didn't even have a full month under its belt, but you've had the first distribution, about 38 cents, which accounted for about 77 basis points for the month. Not a bad number there, and people can do the math. It seems that it's in line with some of the other ETFs that you're offering, and it's not always easy to look for option income outside the US, but you guys have done that.
Yeah, I think what we're excited about is following suit with our core thesis and the products we bring out to market is that income opportunity now for international equities. International equities has actually historically been a place where dividend paying stocks, right, have been able to be purchased in above average income, right? Because you're taking slightly more risk, albeit this is developed. But when you start to get into more emerging and other areas, they pay higher distributions to be competitive. And so now we're able to take what is the opportunity with Paul and the MSCI team, deliver what we've now just discussed is really the largest benchmark to international equities ex North America, but do that with our innovative, right, option overlay. And so as Troy's mentioning, and you were talking about, right, we've heard opportunities for diversification in portfolios, absolutely. But there's also just great volatility to leverage on international equities, just like we've done on a lot of our core other products. And so as we look at the ability for portfolio allocations and talk with advisors and talk with investors, it's diversification. It's allowing investors to also make a tactical view on, right, valuations, on opportunities in their portfolios, but not having to give up the income opportunity just to be long international equities. And I would arguably say, as we think about like our specific space, there are maybe one, maybe two other products out in the marketplace today that has any option component within international equities, and certainly not doing it the same way we do with index options and our tax loss harvesting and all this stuff that's like core to the rest of our investment thesis for our products. And so just really excited just to have another solution for, portfolio construction for investors and espousing their views.
Yeah, and without nerding out here, Troy, Garrett was touching on the right options as you last year had in many of your pillars in your offering in the 90s as far as return of capital numbers. Pretty impressive. Not to say you know what this might be looking for going forward, but most importantly, having index options available provides an instant tax advantage. Can you talk about that a little further?
Sure. So in this product, we get to use the MXEA index options, and that's one of the benefits with partnering with MSCI is the access to these index options and being able to get the 1256 treatment. I know we've talked about it before, but getting that 1256 rule, which gives you 60% long-term cap gains, 40% short-term cap gains, no matter the holding period. If you think about how we manage this product where we're rolling the options on a monthly basis, there's going to be an associated profit and loss every month to those trades. And getting that index option in there really helps with that tax efficiency at the end of the year when you're going to look at your 1099. So it's important for us to be able to trade these, have these as part of the portfolio, and also the liquidity we get within those index options. Being a broad-based index is really beneficial to the fund.
Paul, back to you. We knew that from a global market capitalization standpoint, 10 years ago, most was outside the U.S. Today, 63% of global market cap is within the U.S. What should the average investor think about when they first hear those numbers, and also take into account valuation when they're thinking about diversification in their portfolios?
Yeah, so I think what the average investor should think about is the history, right? I mean, as a data firm with 55 years worth of global markets history, we constantly come back to that point. And the 60% and change that you referenced, Tom, is at an all-time high, right? If you look at different periods in market history, you can go to the Nifty 50 era in the early 70s. You can go to the tech bubble in the late 90s. Those are the only periods in time where U.S. total percentage of global equity market cap was even remotely close to where it is now. And what I would encourage your listeners to think about is that all great runs at some point have to come back to earth, and there's an element of mean reversion that's always at play in finance, whether it's some of those examples I cited, whether it's Japan in the late 80s, literally accounting for almost a third of global market cap. There is an element of mean reversion at work, and it makes some of the points that Garrett made on diversification all that much more important, because frankly, as U.S. citizens, and mostly I suspect a U.S. audience, we're all pretty invested in the U.S. already, and so having part of your portfolio outside of the U.S. makes a ton of sense.
And it's a good message. I mean, look, if you're an investor and you've enjoyed this U.S. run, good for you. But don't forget there's a big world out there. And the NEOS team, again, with this move, aims to make sure that they give you everything to properly diversify your portfolio with getting that tax-efficient monthly income. Paul, thanks for being with us. Garrett, Troy, as always, nice job, and we'll see you next month.